Does charm matter? Well, if you trade options, it does. Welcome, fellow traders, to this brief introduction why charm matters. And when I talk about charm, I talk about options charm. So what is option charm? Let's go right into the presentation. Option charm is also called Delta-Decay, and the second name, Delta-Decay, already gives a little bit away, and it's all about market mechanics. There are certain rules a market has to follow, and we always say, yeah, well, a market doesn't have to follow any rules. This is true, but if you don't follow these rules, you might end up lose money, especially if you're a market maker or a risk manager. So you better follow these rules, or at least know why you're not following them. Therefore, you have to understand them. Who am I? Thorsten Roland Wegener. I used to be a market maker. I'm now retired from the industry. I'm just doing my own business, and I started as a market maker at West LB in Germany, which was by then the third or fourth largest bank in Germany, became a chief trader, head of trading for the warrants and structured products, moved to London, became head of equity derivatives at Penmuir Gordon, a small private bank, well, not that small. West LB had bought at the time. Somebody found out my wife's English, so they sent me over. And then I joined Bear Stearns as head of securitized equity derivatives for the German-speaking market and the UK market, and retired as a partner at Bear Stearns. So let's get on with it. I love this. Option charm or Delta-Decay, the agenda today. What is charm? What does it do? Why does it do what it does? How does it do it? Who the hell is doing what? And fast or slow markets. That's when it's getting interesting. And you've seen I've always put the little E in the brackets because in literature, people don't seem to be able to decide whether it's charm with an E or charm without an E. I prefer actually Delta-Decay, but let's call it charm because it's such a nice play on words. What is charm? Greeks, Romans, and the diverse, I've called it. Obviously, we're talking about black skulls here. These are the option sensitivities, and I have them all here on the screen. On the left, you see the option price, black skulls, and then we have delta, vega, theta, rho, and then we have the next derivative, and this case is delta versus time. One of the German YouTube teachers had a fantastic line. He said, well, does it really matter if you know how to calculate the second derivative of something against volatility squared by night? I'm paraphrasing here. I had a big laugh about that, and I thought, you don't have to do the calculations, but you better know what happens when things are moving in markets. So yes, they are helpful. You don't have to do the calculation yourself, but you have to know what happens and what these calculations could indicate you. But you can also explain it, hopefully, in a way that everybody can understand it, and that's the aim of me today. Leave a comment whether I achieved that or not. So, what does it do? We have to stay or begin with the delta again. Obviously, the charm is the decay of the delta over time, so let's do a quick repeat about what the delta actually is. The delta as on-screen probability. This is a trading screen. I use tastytrade. I like their software. It's easy to use, and let me quick run you through why we're talking about the delta here and what happens to it when time goes on. Here you can see the last price. That was the SPY, obviously a while back already. We're trading at 650 at the moment, but that doesn't change the concept behind it. So you can see here a 25-day option at expiration, and this is the at-the-money price, 433, and the market is trading at 433. That's what we're interested in, 25 days to maturity, so roughly a month. And what we are interested in is the delta here. And the delta gives us a number, 0.5. for the at-the-money option. What does that actually mean? If you now would buy this option, the bell curve, the distribution of possible returns, would indicate you that in 25 days' time, when this thing expires, you have a chance of 50-50 to be above 433 or be below 433. Why is that? Because the assumption of the bell curve is, and as proof over proof over proof of that, and Nobel Prize is fed on the ground, that we follow a random distribution, in the long term at least, and that's the tool we are going to use. So if the market today is at 433 and you buy a call or put with 433, in 25 days time, the probability today is like a coin toss, roughly, yeah, 50-50, that you will be either above 433 or below 433. That's a delta of 0.5. And when we buy a contract, we buy a contract which covers 100 options. So simply multiply it by 100 and you have your delta 50. That's the lingo people are using. So, same example again, but this time we look at an out of the money call with a strike of 446. Yeah, the market is still trading at 433, and we are now having a look at the 446 call. You already see the delta here is 0.15. What does that mean? You only have a 15% probability that per expiration after 25 days, we will above 446. And we have an 85% probability that we will be somewhere below here. So you can already make up your mind. Which one of these options would be more expensive? The one that gives you a 50-50 chance or the one that gives you only 15% chance? Of course, I don't have to ask for the answer. So, but it also gives us a hedge ratio. And that hedge ratio, I'll explain in a second, is very important for you to understand the market, because people like I, as a market maker, or the dealers out there, or the big hedge funds, they have to control their positions and they're hedging their risks. How do they do that? They buy or sell options and they trade in the underlying. And the delta gives us a ratio, how much underlying I have to buy or sell when I have an option position. Yeah? Because what market makers want to do, we want to get market neutral. I'm not in the business of having a directional idea. That's the prop traders, yeah, the tough guys who say, okay, I believe markets are going to crash, or we see a melt up in the markets. As a market maker, I'm selling something a little bit above what we think is fair value and buy it a little bit below of what is fair value. In the meantime, I'm agnostic to the fact whether markets go up or down. I just have to manage my risk. Therefore, I'm interested in this hedge ratio, and that drives markets. So, simple example. We have an at-the-money call. Yeah, the stock market, or whatever you're looking at. The stock is at 100, and the strike price for this option, call option, is at 100 as well. We've already established as a 50-50 chance that per expiration it will be above 100 or below 100. So with every dollar the underlying moves, you make 50 cents to the upside or 50 cents to the downside. Right? So that already gives you an idea how you will have to hedge this position. Yeah? Let's assume we know I have this long call here at the money and the market moves up. So the market moves up by $1. I make 50 cents on it. So I have to sell half a share. As we do it in 100s, I simply say I have this one contract and every dollar up makes $50 for me. I'll have to sell, well, half the shares because I want to lose these $50 to be market neutral against the little wobbles in the market. And the same is obviously true if I sell the call, then I have to do the opposite, because I have to buy the shares then. All right. Rate of change, delta gains or lost in relation to asset price. And then we are through the delta bit actually. I always define deltas lost or gained. And when you buy an at-the-money call, you know the relationship. If the markets go up, your delta becomes bigger. It's getting larger. With every dollar, the market goes in your direction. You have a certain convexity in there. So the first dollar up, you earn 50 cents. The next dollar up, you earn, 60 cents. The next dollar up, you earn 65 cents. The next dollar up, you earn 67 cents. You see there's already a decreasing increase in your delta. This is the so-called gamma, and you will find videos on my channel in English as well where I explain this concept. Same is true if the market falls. The market falls by $1, you lose 50 cents. Then the market falls another $1, you're losing, the delta now becomes smaller, yeah, because we are long the option, but it becomes smaller by a decreasing rate. So we have this convexity in here, which in the worst case scenario, yeah, you bought the at the money 100 call and the market is trading at 20. It doesn't matter. Your call doesn't lose or gain any value anymore. The opposite is true if you're on the upside. Obviously, if you buy the 100 call and the market's trading at 300, then the option will move just as the underlying does. $1 up in the underlying, you make $1 profit in your option. If it's deep in the money, $1 down, you lose $1 in your deep in the money option. So we can put a beautiful curve on top of that. That's the red line we have here. and you see this convexity. If you're long an option, works for you. Yeah? If the market goes up, you become more long, and the market goes against you, you become less long. You still lose money, but you become less long. And this degree, how much delta you are gaining or losing, is the gamma, which we have here. And we see gamma is highest at the money. Simply means if you want to really have a good bang for your buck in terms of when is my delta moving fastest, you go in at the money. So, how does it does what it does? Don't forget, we are still talking about Charme or Delta-Decay. So when positions start decaying, soon at an OPEX near you, that's when it's getting really interesting, because we have OPEX, well, now every day with the 0 days to expiration options, but we have the big four, excuse me, and where a lot of volume is traded, and this volume implies that market maker who are hedging their risks will have to do something to keep their risks under control or getting market neutral again. So, Charme, delta versus time. What does that actually mean? Have a look at this beautiful chart, beautiful colors. In my example, it's an at the money call, and I've put the delta for one contract of an at the money call in here. The only difference is this is 90 days to maturity, then I went down to 45 days to maturity, to 21 days, and to 5 days to maturity. What can you see? What I implied already at the beginning. The chance, if you're at the money, the market is at 100 and you buy a 100 call, it's always 50-50. Yeah? If we assume the bell curve is correct and markets are basically random, yeah? Then it doesn't matter how much time to maturity you have. Your delta at this point and your hedge ratio is 50. And here we have the bell curve. So now I've taken an out of the money call and here's something completely different. When you open this call, let's say you buy it 90 days into the future, it has a delta, a probability that it will expire in the money of 33%. Then time passes by and we only have 45 days left on the clock. Suddenly, my probability has decreased from 33% to 25%. And then another couple of days goes in, we are at the famous 21-day threshold. Yeah? So suddenly my delta has decreased again from 25 to 16.03. And when we have only 5 days left, we are down to a delta of 1.91, which was initially 32. Yeah? Here we have the bell curve, the 15% in the example of the yellow line, the yellow bar I had in here. So this change, this rate of change, can also be interpreted as the Delta-Decay, and that can be calculated with a formula. You don't have to be able to compute the second derivatives of anything, you just have to understand what it means. In this case, it means every day, the next day, has a change in your delta of 0.11 per option. If we're at 45 days, and the next day comes in, it's not longer 0.11, it's increasing to 0.26. And we are moving towards expiration. Suddenly you see it goes up and it goes up, and that's exactly what we have seen here with our delta for out of the money options. You can think for a moment about it. What does that mean for in the money options? But I don't want to make a 2-hour video here. So at the moment we're just at the out of the money options because that's interesting for a lot of you guys who are out there who are selling options to receive the premium. So who the hell is doing what in this whole game? Use it or lose it. Getting market neutral or not. And of course I have again drafted in my fellow colleague Bully, who is an accomplished options seller, and we go into an easy example. Yeah? One of the guys, that's me on the left, has to do something, and the guy on the right can do something, but he doesn't really have to. That's not the aim of his strategy. So what does he do? He says, oh, well, great. We have 20 days left on the clock, and the market is trading at 100. Torsten, the market maker, please make me a bid for an call with a strike of 105. Okay, I say fine. I think I can pay you 40 cents. Yeah? And in reality, I think obviously I'm paying less than it's worth. That's why I'm doing the deal. But Bully is happy with this. Okay, fine. He takes 50 cents out of my pocket, and I have now a long option, represented here by the green bar, and bully is short the call. So far, so good. So what's happening now? That's the investor position, or what bully is doing. He sold an out-of-the-money call. In our example, it was the 105. And as it's 100 options per contract, it's 100 options he's short. It's, funny enough, a 16 delta, the 105, which means now that he's short the call, he is 16 deltas short, which means with every dollar going up, he's going to lose because he's short the call 16 cents on the dollar. What's his hedge? Nothing. He has the idea that nothing is going to happen, it's pretty much worthless, and selling a call, the market just has to stay where it is or even go down, he'll make his money, and he has a charm of 0.6 in this example. So what happens 10 days later? His delta has now decreased to minus 8 deltas. How did that happen? We have a negative charm, and he starts with a negative delta. Time is only becoming shorter. We can't reverse it, which means I have minus 16 deltas minus a charm of minus 0.6, and minus is plus, and if I add something to a negative number, this negative number gets smaller, I want to say. So we're going up. It's now minus 8. Fine. That means the probability that he's going to lose money shrunk from 16 to minus 8. Fantastic. He's happy, and as we've seen earlier, obviously the charm, the rate of change of the delta is increasing the closer we go to expiration. So how's my position? I'm the market maker. I'm now along this bloody call, which is probably not going to do anything, and I have the positive delta out of it. And what am I doing? My delta position is now 16. If the market goes down, I lose 16 cents. I don't want to do that. So I want to hedge my delta. So I go in and sell 16 shares against it. So if the market goes up, I own the call. I make 16 cents on the dollar. If the market goes, and I lose 16 cents on the dollar on the hedge, and vice versa. So now we have the same 10 days later. The same is true, obviously, for me. The out of the money call I have, it started with a delta of 16. The probability was 16% that this thing per expiration could end up in the money. This probability is going down, right? So 10 days have moved on, and now the probability is not longer 16 that this option I bought is in the money. The delta, the positive delta, the probability has come down, but I'm still short 16 shares against it. So my net delta position out of this trade is now minus 8 deltas. The physical shares, delta is not changing. A delta is a delta is a delta and stays a delta. The delta of my call option, which I'm long, is decreasing because the market is not doing anything. The probability is getting smaller. So my hedge ratio says if I still want to be neutral against all eventualities, market moves up or down, I have to go into the market and buy another 8 shares. And then I am neutral again. And that's what market makers all over the world are doing all the time to keep their risk in line and say, I'm not interested in the moves of the market up or down. I want to be hedged, but obviously you can already see the implication. These guys who have to hedge their risks are coming into the markets, and we have seen markets, especially when the maturity gets shorter, my charm is increasing. And with an increasing charm, for out of the money options, they get worth less, and in the money options get worth more. Now I've answered the question from earlier. I have to do hedge transaction, and these hedge transactions I see in the market. So the first step is, let's go stay here for a second. The first step is you identify in the market where is the open interest, where are all the big blocks. You can do that for single stocks, you can do that for indices. You say, okay, is the market moving at all? If the market is not moving at all, and we are getting closer and closer to expiration, to OPEX, obviously there's an influence in there. And I can have a look, and I just have to make, you have to make the call. Is it the guy who actually trades his charm, or is it the guy who's not trading his charm? Who is in charge in this case? So the customer, bully in my example, is usually not doing anything, at least as long as he doesn't have to do anything. But the market makers will do things. So you will see their footprint in the market. And let's say the market starts climbing up and climbing up. Why? Because in this scenario I just showed you, I have to buy shares when time goes out. That's obviously not good for not good for bullish position, more for mine, because I'm moving the market ever so slightly in my direction. So there are obviously a couple of other things you should know about it, but there are good books, come with a recommendation at the end, how you can get a little bit closer into it. I called it Charme or Delta-Decay, a little summary, more things to know. Shorter maturities have more charm. Talked about it in epic length. Volatility has surprisingly smaller influence on charm. Charme is highs around a delta of plus minus 15 and a delta of plus minus 85. The one standard deviation in the money and out of the money. That's where the most charm happens. And then charm at 50 delta is near zero until it isn't. Why did I write down there until it isn't? Because assume you have an option, long or short, at the money, and we are moving into OPEX, and it stays where it is until it suddenly makes a move. We already know charm is almost zero when we're at the money, but we know that our standard deviations move in, move in, move in, move in, move in, the shorter the time period gets. And then we also know that at the 15 delta and 85 delta, my charm is the largest. So suddenly you're moving slowly out and boom, there you have it. Suddenly this thing starts moving and you have to take actions. So things get busy around the OPEX cycle. What you can see here, a couple of things, end of month, week 1, week 2, OPEX, week end of month. It's an rinse, how do you call it? Lather, rinse, repeat process we can get through. And if you like this video, you might want to watch the video where I explain the gamma coffins and the gamma flips and the gamma squeezes, because this is what you will see happening all the time. At the moment, the market is trading at 6,500. There's a huge block of gammas, for example, at 6,500. There might be a pin right in there. So we'll see next week what will happen, and I might update that video at one point in the future. So today we talked about charm, the influence of the delta versus time. Obviously there is color, gamma versus time, and gamma versus volatility, and I think I already made a video about Vanna, delta versus volatility on this channel. So allow me one plug. If you see that before the, the 12th of September, you still have a chance, if you speak German, live in Germany, to register for my option and macro bootcamp. On Friday, this Friday, close of business, I'm closing the books, and I'm not so sure whether the next bootcamp in 2026 might be in English and might happen in the UK, the United States, or in Hong Kong, or wherever I think it might make a lot of fun. And it's a little rant, because at the moment, for every additional hour I'm working in Germany, 12 minutes I work for myself. And I don't know, something is here totally wrong. For every hour you put in work, additionally on top of what you're doing else, 12 minutes is what I'm benefiting from. And I don't like that, because, hey, I'm a trader and I trade value for value, and we don't have that here anymore. So if you want to use the chance to see this in German and not in English next year, be my guest, contact me on the website, and that's the first step to become. I took that at my annual offsite from our, we call it the Friendly Crocodile Society, long story, of my virtual trading floor offsite we just had a month ago. So the first step is come and see us, join our seminar, learn about options, learn everything you need to know on a professional level, and hey, it's all about not losing money. If you get that under control, the market is an oyster. So I thank you for your attention. If you like the lecture, please like, share, and comment. You'll find us on my website. There are publications I occasionally publish. There are a lot of good videos. There are a couple of downloads in there. Obviously, you can register for the seminar on the German page, because, hey, it's the last German seminar, at least in 25. Book recommendations. I've added one new good book. I spoke to Larry yesterday. Lawrence McDonald, he used to be a distress trader at Lehman Brothers, terrific guy. And I read his book about Lehman, and at the moment I'm reading his new book, How to Listen When Markets Speak, and can only recommend it. All the other books I don't have to say much further about it. Obviously, always going back to Sheldon Nadenberg, Option Volatility and Pricing. If you want to already dive into Charme on your own, that's the book you have to check out. Very good explained. Big fan. Now I've got to slip you the risk disclaimer. Everything I told you today is no recommendation for trading. It's not investment advice. It's not planned as investment advice. It never should be investment advice. It's a lecture about a concept that is behind it and 5 cents of my experience for you in this market as well. I hope you enjoyed it. I hope I see you soon on this channel, and there will be more English speaking programs follow. You came for the content, you stayed for the accent. Bye bye.